Hey, good morning, everyone. Marty Mazzora here, January 11th, 2020, with your macro update. What I've done here, folks, is essentially what I did the last time I did one of these for you, and that was really to articulate our current macro assessment. And then remember, that was part one of a part two video where I actually explored with you our new core allocation. Got a lot of really good feedback on that particular macro presentation. So that's something I'm going to, not every week, but once or twice a month, I'll pop in as I score our indices and give you some of the meat of what we're finding. And for you clients, of course, we're always doing this to keep you intimate with what we're thinking, why we're making the decisions we're making within your portfolios, and so on. So the best way to do that is to talk about general conditions. I do talk about market technicals from time to time on the blog, and I'll do little videos on that as well. But at the end of the day, it's really underlying general conditions that count in our view. So let's go ahead and we'll look at some of the quote bad things that we're finding in our data, some of the good things, and then once again, we'll take a look below the surface and see what lies down there, and then I'll finish up with some perspective on the market. Okay, so general conditions, the bad stuff, some of this is going to look familiar. The ISMs, the manufacturing survey was expected to get better. It actually got worse. 47.2 is a recession, essentially, in the manufacturing sector from a sentiment standpoint. You can see we haven't been there since the last recession. Services actually got better. We actually bumped up to 55. The trend still isn't good, but that was encouraging. So the services sector is optimistic as of December survey. The manufacturing sector is not. New orders, something like a 90-month low, right about here, but certainly we haven't seen this level. We saw it first again, not for years, until we dipped into the greatest recession since the Great Depression, and that's where we are now. Not a good look, you would agree. Industrial production still just a tiny tick better. Really bad looking chart relative to what it looks like historically. We did have this manufacturing recession, they say, in 2015. So we'll see. Could we rebound out of this? Of course. Should we bet on it? No, of course not. Durable goods orders. Looks like the industrial production on both a headline and then X out transportation. Not a good look. You can see how it looks relative to past recessions. Truck tonnage rolled over. I was a bit surprised given the timing, retail season, and so forth, but that's a big rolling over in truck tonnage, so that scores red on our indexes from a high level, but that's rolling over in a hurry. We are hearing about more trucking companies going out of business in 2019 versus 2018, layoffs in the sector. So a far cry from where we were back in here where they couldn't find drivers. You can see how it looks going into and during past recessions. Rail traffic confirms the bad look for truck tonnage. Not a good look in weekly rail traffic, carloads and intermodal. Cass freight system really rolling over. Their economist thinks we are in recession. I don't think so, but I think we're getting too close for comfort. Capacity utilization, to what degree are factories running at capacity? 77%, slight uptick, still not nearly running to full capacity. Commercial and industrial loans, smooth this one out with the 10-month moving average because it's so noisy. That's just a really poor looking trend. We know that companies are borrowing money. We're going to touch on that in a minute, but they're not going to the banks and borrowing on for expansion, essentially. The leading economic indicator, coincident economic indicator ratio, leading indicators are things like hours worked, jobless claims, new orders, and so forth, forward-looking things. On the ground right now, things, what are payrolls last month, what's personal income, industrial production, so on. This is a look you do not want to see, where the leading indicators are underperforming the coincident indicators. I'll say it used to be a really reliable signal that the economy is slowing. We know that from other places, but we did have a false signal back here in the 90s, which was the previous longest expansion ever. This is the third one, so we'll see if this is telling as it's been in the past. You can see false signals were rare in the past. So a third soft landing, maybe. Good stuff or better stuff. Same look I showed you last time. Retail sales, higher lows, good looking on the online end. Auto sales, we came down a little bit. We're still in this symmetrical triangle. This isn't a bearish look. It's not a bullish look, but it's not a bearish look. This is a bearish look. Consumer spending, picking up higher low, 10-month moving average. Okay, again, we want to see a higher high before we're really bullish, but that doesn't say bad things. Consumer sentiment, it's kind of tough to put this one in here. We did this. I need to update. Got a little bit better here on the Bloomberg Comfort Index, which is a weekly survey. These two are still, we do have lower highs, not looking good. University of Michigan, we did see a nice uptick there. It was flat on the Conference Board survey. So again, not recessionary, not great. Housing starts, yes, that's a good look. That's housing looks strong. Housing permits look strong. Weekly jobless claims came down a little bit this last week. You can't see it here. I blogged about it. Continuing claims bumped by 75,000 week over week, and it's like the fourth consecutive week of increasing continuing claims. Okay, so with the employment numbers, largely the level's important, but it's not the level, it's the shape and it's the trajectory. Because as you can see, once the data begins to look suspect, it's almost like the ball game is over. You just look at they just barely bottom and begin to rise, and we're in the greatest recession since the Great Depression. Hardly any lag here, a little bit more here, a few months before the tech bubble burst. For the most part, as you can see, with some exceptions, you need to get very careful, or we do, with your money when the jobs data begins to wane. Unemployment rate, 3.5%. It stayed there. I did write in the weekly message, I covered several points about the employment numbers. I didn't read that. Please take a look at it. It's not long. Again, I like this. When have we ever had unemployment that low? A lot of people are going to say that's wonderful. Well, it's wonderful until immediately after it stops being wonderful. Then we have huge concerns. I've said it before. Once labor cracks, I think the economy cracks. Okay, under the surface stuff. Fed balance sheet looks like an elephant. Crazy. Fed printing money, just sticking it in banks, pulling all the stuff the banks have, treasuries and back in here, mortgage-backed securities mostly, or largely, off of bank balance sheets, giving them more liquidity, pushing interest rates ever lower. The repo issue that I've talked about here on the blog, that's what this is all about. And just concerns. Believe it or not, folks, the Fed will talk about guidance. I wrote about that the other day as well. If guidance is a tool to keep the market okay or keep the economy okay, then you're never going to guide lower, right? And there could be guidance on interest rates. Really doesn't matter. Whatever the guidance is, your job is to keep the economy humming, which is impossible because it's a cyclical economy. You're either going to keep it humming for a while longer and build up massive bubbles, or you're going to allow the markets to do their things and to correct imbalances along the way and have slowdowns and recessions and not massive bubbles. The Fed and bless them. If I had their job, I'd be trying to do the same thing. I just wouldn't take their job. Of course, it would never be offered to me. But the problem with those folks is not that they're not good people. It's just that they're trying to do their job, and it's impossible, frankly. Okay, so speaking of the Fed, I showed you this last time, just real quick. The repo activity, overnight funding of banks, helping each other out as the Fed steps in when they need to. Of course, they need to during recessions. Would they need to during expansions? To a record extent. And this is September. They're doing it still today. They said they do this for a few days. Something's wrong with the plumbing for sure. Triple B corporate debt is virtually half of all investment grade debt out there. I've talked about this a lot. Pension funds can't own junk bonds. A lot of endowments can't own junk bonds. Economy wanes, BB becomes double B, and all hell breaks loose in the credit markets because there's not the liquidity to take care of that. Yields spike, defaults begin to happen, and so on. High yield credit spread. 10-year junk bonds index the average yield versus 10-year treasuries. That's crazy low. That actually scores very well on our index. That says there's no financial stress in the system. But folks, you have to take every period and what's going on into its proper context. This is the result of huge chasing of yields, not finding yields anywhere safe, and being willing to go into the junk bond market while the world is telling you the economy is rosy again. When that begins to spike, we could be in trouble. Junk bonds spread over triple B investment grade bonds is virtually nothing, which means there's just this huge appetite right now for junk bonds. If that goes away in a hurry, huge problems, I think, develop. More corporate debt today than consumer debt since 1991. Moody's, again, I did this last time, allow me to repeat. Investors have a voracious appetite for high yield debt, fueled by that big elephant I showed you, quantitative easing, the Fed printing money, paving the way for unprecedented weakness in companies' capital structures. Folks, there was an article on Bloomberg yesterday. So far this year, we are setting the records in money flowing to junk bonds and weakening capital structures further. Investors, no doubt, unequivocally, except for you clients out there, at least that's our goal, will enter the next downturn more poorly positioned. Percentage of first-time debt issuers, B3, is 40% today, twice what it was during the Great Recession. Defaults could swell. Yeah, they definitely could. The IMF's Global Financial Stability Report, one of the most robust depictions of financial stress in the world, something that we pay very close attention to, at least their commentary as they do their job. Easier financial conditions has encouraged more financial risk-taking and a buildup in vulnerabilities. In the corporate and the non-bank sectors in several large economies, we're seeing elevated vulnerabilities. Insurance companies, pension funds, as I mentioned, and other institutional investors having to go to the riskiest, less liquid securities that they can. Of course, a rise in corporate debt burdens. Share of debt owned by firms with weak repayment capacity in several major economies, it says could, is reaching post-global financial crisis levels. Search for yield in a prolonged interest rate environment has led to stretch valuations and risky assets for sure. Institutional investors looking for yield lead to exposures that may amplify shocks during market stress. Similarities in investment funds, everybody's chasing the same stuff. Current anticipated monetary policy accommodation has substantially boosted risks, absolutely unequivocally, no doubt about it. Companies, this one's a little old. I've got to find an updated chart, but don't have this in my database, but I know it's happening. As of the end of 2018, still the case. Companies are borrowing more than their free cash flow to give it back to shareholders in dividends and share buybacks. Bad things tend to happen, Great Recession, tech bubble burst, when this happens for a long period of time. Ray Dalio, great book. When prices have been driven by a lot of leveraged buying and the market gets long, leveraged and overpriced, it's ripe for a reversal. This is me, leveraged share buybacks. Borrowing to buy back shares is that definition. Share repurchases have exceeded cash flow since 2014. Showed you that just then. And McDonald's is now a triple B rating from an A, all because of borrowing to buy back shares, because their executives get 80% of their pay package based on earnings per share. $5.04 trillion of capital flowing into the stock market from the companies themselves, buying back their own stocks. Not much from investors, the green line. Net outflows in mutual funds and ETFs. That's just not the kind of healthy look that says, give me more, in my view. Okay, this week, CEOs, conference board, top concerns. U.S., number one concern, recession risk. Global, U.S., Europe, Latin America, number two, China, number one, Japan, number two. Need I say more, folks? Who's responsible for creating jobs out there? Consumer confidence versus CEO confidence. We did, on balance, though, get a nice boost. It's not a nice, expansion phase boost, but it's a nice boost, and you do get boosts, even while things are getting sketchy. But I'll take it. But still, as I just showed you, CEOs are not feeling great. Consumers are feeling a lot better, but they tend to right up to the very end. Duke University CFO survey that came out this week as well. 52% of CFOs see recession. That was 56, by the way, the previous quarter. So that's an improvement. 76% see recession by mid-2021. Of course, that adds up to a lot more than 100. So some people must be saying yes and yes. Okay. Preparing, 59% strengthening their balance sheets. That's good when you look at this debt picture, right? The problem is when they do that, it could just be the straw that breaks the economy's back. 58% cutting costs, 31% scaling back investment, 54% stockpiling cash, and I hope they're paying off debt once they get it stockpiled. Deloitte does a very good survey. They call it the CFO Signals Survey. They just did theirs for the fourth quarter. Expecting a downturn. Actually, 97% expect the economy to slow. 85% have taken at least one step to accommodate for that. 57% are cutting costs, 35% are cutting jobs, right? Remember, I wrote about the disappointing jobs number. Concerned about financial markets, 77% say stocks are overvalued. I concur. 4% say they're undervalued. Okay, so just an update. Ones I've shown you before. Earnings per share. Yes, earnings per share rolling over. In the tech bubble, 50% drop, rolling over real estate bubble, 58% drop, rolling over 2015, 15% drop, rolling over now, all-time highs. We'll see what happens. Profit margins rolling over, 22% drop, rolling over 50%, rolling over 58% drop, 22% drop, 16% rolling over, market at all-time highs. What could go wrong? Okay, I don't like this chart. S&P 500 price versus corporate profits. What do you mean corporate profits are down? Look at earnings per share. Share buybacks, right? You don't have to make any more money to boost your earnings per share. You just need to lower the number of shares you have out so that the current earnings divided by that make your earnings per share go up and you get a big bonus on your annual paycheck. 1999, that's what it looked like. This was not a stock market bubble, by the way, folks. This was a real estate and credit bubble, so market looked fine going into that one. This is not a good look. Are profits really going to explode to justify those prices? Anything's possible. Speaking of 1999, IPOs with negative earnings per share today, then. Longest bull market in history, I always say just saying, because they don't die of old age, but they die of stupidity, frankly, excesses. They die of debt in some sector. Forward PE. Come down a little bit because despite what I'm showing you right now, analysts are beginning to ramp up earnings projections for next year. So 18.5, historically not bad. That's not, run for the hills kind of thing. Certainly not in foreign developed and foreign emerging. It's actually just a little higher than it was before this big crack and a lot lower there. But folks, remember, price to earnings ratio, price to earnings per share. When you bought back your shares and pushed up your earnings per share, that should be lower, not higher, if we weren't in some sort of a bubbly kind of territory. Price to sales is officially off the charts. This was as expensive, I think, as stocks have ever been. More expensive than that now. Price to harder to manipulate sales basis. But still, when you buy down your shares outstanding or buy them back, you should have a lower price to sales per share ratio, right? Because you have fewer shares to divide by the same amount of sales. What would it be without all the share buybacks? Buffett's indicator, total market cap to GDP, all-time records. Buffett, last report, he had almost 140 billion in cash that he couldn't find anything to do with. He said this in his last Berkshire shareholder meeting, prices are sky high for businesses that he might otherwise want to buy. Okay, so if the consumer is the glue that holds it all together, and I'm saying the consumer is in good shape, and look at the mortgage. I like, you got to like the residential real estate market. I don't like any market during a recession, so it's going to suffer. There's no doubt about it, but we can't say that it's the problem right now. But what about auto loans? 90+ day delinquency in consumer auto loan rates. That looks troublesome for sure. And then credit cards, delinquency rates are low, but again, there's the level and then there's the trend, and the rate of change is probably more important. So that's something to pay attention to. Okay, our index slightly below. Again, not screaming recession, but certainly not screaming go all out in the bull market with your money. And our back tests, shown you this before. If we were running this analysis back then, which we weren't, if we were doing it just like we were today, we would have got defensive. Market would have run up 17% before it wiped out 3 years of gains with a 50% decline. Right here, market rolled over, market ran up like 15%, before it wiped out 11 years of gains. Market rolled over here. We started hedging portfolios, limiting our upside potential. I think we're like up right between these two. I think it's like 15, 16% since then. Again, I preached this all along, which is why we did the call spread so we could capture some after a certain level. Nonetheless, it's been quite the move. So, should we jump back on that bandwagon? Well, that remains to be seen. You could say to me, but Marty, we had our bear market. On an intraday basis, it went down 20% the fourth quarter of 2018. 20% is a bear market. Now, the reason people aren't calling it a bear market is because it was 19.88% on a closing basis. And you say, so, once you have your bear market and you come out of it, things tend to do really, really well. Well, a couple of points. That would be one of the shortest bear markets in history, no doubt about it. And again, folks, it's not the price of stocks. I do show you some technicals. We look at those. It's not the price action in stocks. It's the underlying fundamentals that we're most concerned with. So on September 24th, back here, when the market was peaking, the business component in our index was hugely bullish, okay? I did write an article like a few days before that, the 10th or 11th, and then another one right before. I said, expect a rough patch because the technicals were screaming correction. But we were not doing anything with client money. And at the bottom, on December 24th, right, back here, when the world, back here when the world was coming to an end, right? No, I was showing you charts that said, I think we're going to bounce out of this and set new records. Because look at our business score. It was up 50. Well, January 10th, yesterday, 2020, are we doing our job? Are we being responsible investors if we're pretending this is going on when this is going on, right? Well, a lot of people want to be bullish, and I get that, and I appreciate that. And they're finding reasons to be bullish here. This is our consumer score yesterday. That's great. I mean, retail sales are good. The consumer looks really, really strong. I would just pose to you, and this isn't to be a doom and gloomer. This is just to be objective. This is to be thoughtful. This is to be not emotional. This is to be not chasing the crowds. Who is responsible for hiring who? Right? Businesses are responsible for hiring the consumer. Okay. I've shown you that when labor begins to roll over, and I just showed you evidence that we may see labor cuts. We may not. Again, I'm open to all possibilities, and I'll be happy to report as the year unfolds something much more rosy than this. But I would say that if these numbers begin to fall in the consumer space, and particularly the jobs numbers, I think the ballgame is probably over, regardless of trade wars and elections and so on. On a global basis, we're a global commodity or a global economy. And by the way, folks, I confess this one I still have to update today. So this is a week old, although I do come in during the week as I see data show up country by country and update it. This is just not a great look. We've got exposures, here in the good-looking spots, right? And we have a lot of exposure, of course, to the U.S. That's our macro score. We should be concerned about Canada and Mexico because they're our second and third largest trading partners. But we do business throughout the world. So again, we'll stop there. This is not a good global look, folks. So yes, the market looks good price-wise. Technicals are improving as the market continues to go higher. The longer-term ones that I show you on the videos are still rolling over in terms of momentum. So, a good technician who looks at the big picture would still tell you it's probably just a matter of time, but it's always just a matter of time. What we're telling you is that the fundamental reality says, be very diversified and follow your portfolio with a put option down below, which is what we're doing for clients. Thank you, as always, for watching and listening, and I'll talk to you again very soon. Bye-bye.